Hey, what's up, everybody? This is John Bloor coming at you live with the third installment of the trading far out of the money options segment. I heard that the final installment, which I did a few days ago, I must have had a bad internet connection, and the quality was pretty poor on the video and stuff. So a couple people complained and said it wasn't so good. So here I am again, coming at you. Going to redo this part 3. This is part 3 of the presentation on trading far out of the money options. So if you haven't seen the first 2 installments, please go back and watch those again. If you have and you're ready to go, then let's jump right into it. But first, wanted to say, how about those markets today? Crazy. Just kidding. There's nothing happening in the markets today. It's so boring. So back to the presentation. So we already covered a lot. So just to quickly do a recap of what we covered. We covered why we're selling out of the money premium, which is, defined risk reward, time frame, etc. The high probability of success in these trades in particular. The fact that they're a little bit more slower moving, especially in the onset, so we don't have to watch them every single day. Great for busy professionals. And an automated system of success where we can use alerts and contingent orders and other things, which again, great for busy professionals, people who work, who can't just watch the markets all day. Let me make sure I'm actually sharing my desktop here. There we go. Now I'm sharing my desktop. Okay, so here's the slide I just talked about. Next slide, how long until I make my millions? Again, I'll reiterate, limits like fears are just an illusion. My man Michael Jordan said that. I love that guy. I'm from Chicago. I can't help it. I'm sorry. If you like LeBron, can't help you there. Anyway, typical returns, people I know, range 20 to 50% range. Really depends on how aggressive and how active you are. If you're more conservative and you're really busy at work, you're just going to kind of put these things on, put your contingent orders in, make trades when you absolutely have to, and just sort of manage it that way. Then you're probably going to be more closer in the 20 to 30% range if you trade well. And if you're more aggressive, you're selling things a little bit closer to the money, and you're a little more active, then you can make 50, 60, 70, 80% returns. My personal results, I tend to be rather conservative, and I work. I have other things going on. I don't just trade full time. So for me, 31% 2012, 34% 2013. However, if you're like somebody like Karen the Super Trader, heck, she's made crazy returns, and she started a hedge fund just on selling far out of the money options. So you never know what's possible. Just to recap, will you lose your shirt? Quite possibly. Your house, your car, your wife, and your kids as well. But there's trade-offs. So like Dan Sheridan says, in options as in life, there are trade-offs. I love that quote. Trade-offs, are everywhere in life and everywhere in options trades. There's going to be no free lunch. You're not just going to have everything be great and perfect and wonderful. It just doesn't work that way. So if you have a high probability of success, then there's going to be usually a risk-reward ratio issue. So with these trades, that's what we get. We have the high probability of success. We have the slower moving trades in the beginning, and as a result, we have a crappy risk-to-reward ratio. So what we have to do there is, instead of saying, oh, well, this is a terrible risk-reward, I don't even want to do this trade, you say, okay, how can I mitigate this? You got to think creatively, and that's what we do with some of the embedded hedges and other things that we do in order to manage that. Just the same if you say, okay, well, since this trade is a crappy risk-reward ratio, I'm going to go in and do a trade that has a much better risk-reward ratio. On the flip side, then you're going to have a much lower probability of profit, and you're going to have to really be on top of that trade because usually it's going to be something that's closer to at the money. And when you're trading things that are at the money, you have to be watching the market much more actively. So again, trade-offs. Always, always, always trade-offs. I'll get to a trade example later, so I don't want to walk through the margin things again. Optimal time frame we talked about before, but just to recap again, 30 days is always what people see in this typical graph that shows option price decay, but 30 days is only for at-the-money options. And remember, the at-the-money options are always changing. So as the market moves up, moves down, the at-the-money options are changing. So the options that have this decay curve are always going to be different. That's going to change on a very regular basis. So it's only whatever options are at the money that decay exponentially within the last 30 days to expiration. So the options that are far out of the money, on the other hand, decay somewhat more like this, which is completely opposite of the curve above. So as we see, they decay, they experience a much larger percentage of decay in anywhere between 90 to say 45 days to expiration, and then once you get within 45 days and even within 30 days, there's very little decay. The option model is flawed in a sense that if you go in and you sell far out of the money options at 30 days, it's going to give you a certain decay level, and it's going to tell you you're going to get a certain level of theta in return in a certain number of days, and then it's not going to happen. I'm telling you, it's not going to happen. You're going to look at that thing and you're going to say, these things are not moving. I'm not making any money. Why am I not making any money? And it's because of this reason. It's because of this graph right here. This has been proven. Smarter people than me have studied this and come to this conclusion. So don't take my word for it. Again, Jim Bittman, options author, very successful trader. Even he says, that there's a flawed belief that option time premium decays exponentially across all strikes. It's not true. It is not true. It's only for at-the-money options. So trust me, if you're going to trade far out of the money options, you want to make sure that you're trading somewhere. I like the 60 to 70 day range. That's kind of my sweet spot. But anywhere between 45 and 90. 90 is a little long. I don't know a lot of people that trade 90 days out, but anywhere between 45 and 90 is going to be where you want to be. 60 to 70 is what I recommend, but not 30. Just not 30. Underlying selection, indexes versus stocks. I prefer the same index. It gives familiarity. It allows me to trade a very methodical, stats and quant-based approach based on all my previous trades. I can look at and see what was a good price, what did I get at this condition in the market, what RVX was I selling, what volatility, for what delta. So all these things allow me to make sure that I'm a better trader after every single trade than I was before. And it also gives me some history and sort of a feedback loop on what is working and what is not working. If you trade a different index or a different stock every single time, you're never going to know if you're getting a good price, if you're not getting a good price, and you're not going to know how that underlying behaves. You're not going to know how it behaves a certain kind of advice or certain kind of market conditions. You want to learn something and just trade it over and over again. Find your advantage and hammer it out in life. So we want to find out or pick one particular area, and then even if you don't trade it every month, that's fine. You don't have to trade it every single month if the conditions aren't optimal. But find out some, maybe a handful that you're going to trade and learn those really well. Keep good notes on your trades and then learn from every single trade, get better, and then trust me, you're going to be more successful down the road than you would if you just keep jumping around. Colin Cowherd, rich is fun, wealth is boring. I believe that to be true. It is. It's definitely true, at least in my trading. So when I first started, I jumped around a lot from different stocks, different indexes. I was very inconsistent, and I got much more consistent when I just decided to focus in, narrow in on a few different indexes, and just trade those methodically. Other factors to consider when picking stock versus index or different indexes: you want something electronically traded, you want liquidity, and you want something that's large enough that you're not going to be spending a ton of money on commissions. You also want to pay attention to European versus American, because if you're trading anything and you're going to have a hedge in there, a close to at-the-money hedge, you might want to make sure that you're not going to get exercised early on that. So take note of American versus European. Puts versus calls versus both. Puts have more juice. That's a fact. We all know that. So I tend to sell more puts than I do sell calls. The puts also have more risk. Stock market takes the staircase up and the elevator down. Um, so what does that mean? It means that typically you're going to find more opportunities in the puts than you would the calls. However, given the current market that we're in right now, this low volatility environment and kind of almost a sideways moving market, not really a clear direction. We've kind of broken onto that really long-term trend, at least in my opinion. So given all those things, I've been really looking at the calls for my next expiration cycle. So I think I might jump in with the calls first, and then if I get the opportunity, jump in with the puts and do maybe more of a condor this month, as opposed to what I've been doing for the last year and a half, like almost 18 expiration cycles, which has been just the put side. And that was because I was doing both sides, and I kept having to manage the calls and just spend a lot of time on the calls and getting hurt on the calls, that I just stopped doing the calls because, the market was trending in that direction. So why fight something? Make it easy on yourself. Units. Remember, fat tail distribution, black swan events happen more frequently than probability than models predict. If you want to learn a little bit about that, just read the book Long-Term Capital Management. You'll love it. If you're watching this presentation, you're in options, you'll love that book. Just read it. Trust me, I just did you a favor. Units are any options with cheap, little to no Greeks. Maybe about 20 cents in the IW or the SPY, maybe somewhere around 80 cents to $1 in a bigger index like the SPX or the Russell. And these things have a hidden delta. They're going to really explode in value. So this is kind of like a secret insurance mechanism you want to use on your trades when you're trading larger, to make sure that you don't go out of business. If you're only trading a couple $1,000s, no big deal. But if you're trading 10,000 or more, I'd highly recommend that you stock up and at least go long on units. That way, if there's a disaster, we're talking like October of 08, we're talking September 11th, events like this, you will be in a much better position than you would be if you didn't have these. You will probably either not lose very much, and you could potentially make money, actually, surprisingly, when a disastrous event happens like that with the right amount of units. And this is the volatility skew, and this is why units work. It's because there's a drastic shift up in this entire curve when the market crashes. Okay, now finally back to where this presentation was supposed to start. What is a good skew to sell? So sort of the underlying premise of this slide is, or I wouldn't say premise, the underlying thought that I'm trying to get across, or idea I'm trying to get across to you guys, is that I want you not to become a robotic trader or blindly sell the same expirations cycles all the time without thinking about it. So I talked earlier about how you should methodically and take a quant-based approach to trading, and work with the same indexes or the same stocks over and over again. But that doesn't mean that you stop thinking. So that means that you're going to become very familiar with how an index works, and you're going to trade kind of in a similar manner all the time, but you're still going to trade and do everything with eyes wide open. So no matter what, you're always going to be looking at the current condition of the macroeconomy. You're going to be looking at what's going on in the market. You're going to be looking at some of the technicals on the index you're trading. You want to take all those factors into account before you put on every single position. And as you're monitoring your positions, be smart, be a trader. Don't just do the same thing over and over again. So, for example, I remember in October of 08, my rules said, according to my rules, I was supposed to, take off and move a position. I was in a condor position, I remember. So I'm in a condor position. October of 08 is sort of happening. All of a sudden, the market starts on a tear down. We're kind of crashing. There's all this fear and all these unknown factors around, the financial stability of our economy and all this other crap. And okay, we'll take off, the put side and reposition. Well, that was what my rules said. And if I was trading completely robotically without thinking, I would have went ahead, I would have taken on my put side and just repositioned and sold again. But I mean, come on, anybody who was paying half attention would know that that probably wasn't the best idea at the time. And there are times when there's fear that's unjust, and people get a little spooked, and there's a quick downturn in the market that you could take advantage of. And then there's other times like October of '08 when the fear is real and you need to take notice. And that was a time that people took notice, and I didn't resell. I stayed out of the market, actually. I remember for about 2 months, I don't think I traded at all. And that's totally fine. Cash is a position, and sometimes it's the best position to be in. So I'm not really a directional kind of trader. Sometimes I wish I knew how to trade a little bit better directionally, because I would have taken advantage much better in a situation like that. But for me, I'm much more of I'm a premium seller, and I like to sell stuff a little bit more non-directionally and just sort of collect theta. I like to collect theta. So, for me, cash and being on the sidelines was the best thing for me to do there, as opposed to trying to do something that I'm not very familiar or very good at, which is trade directionally. So, yeah, be smart, be a trader. And then, as far as what is a good skew to sell, you want to sell a steep curve. What does that mean? Well, this volatility skew. This is the skew right here. This is what they call the volatility smile. This is typical for most indexes and most stocks. Now, if you're talking like futures and all kinds of other things, then this could look different, or gold or oil. This curve might look differently. But for most standard stocks, your SPX, your Russell, SPY, IWM, Apple, any of those stocks, IBM, those are going to have this typical volatility smile, in which the puts have a much higher volatility and therefore higher risk than the calls do. So this would be the puts out here. This would be the strikes. You're far out of the money. Put options would be way out here with a very high volatility level. And as you move closer to the money, that's going to start to level off. The volatility is going to come down and down and down and down. And so you get at the money, and then again, this is going to be your out of the money calls out here, which usually have a slight uptick in terms of volatility. So this is your volatility skew right here. Now, when I say a steep skew, it means you want to sell a skew that tends to be steep in the back here, meaning you're selling a lot of high vol, you're selling a lot of juice. A flat curve is going to be something a little bit more like this. That means you're not selling a high volatility level. You're selling a low volatility level. So you want to sell a steep curve. That means you want to get a good price. It just means that if you sell, you want to get a good price. That's all that really means. So the way that we find out if we are getting a good price is, number one, you look at your history. You look at your last 10, 12 trades, or however many you have on your books, and you say, okay, what's a good price? I mean, that's what I do right now. I keep spreadsheets of all my trades, and when I go back and I look at a trade, I say, okay, what's a good price for this? And I know that if I'm going to sell a 8 delta on the Russell, that $1.85 is probably a pretty decent price for what I'm going to get. If I'm going to sell a 10 delta, then $2 is justified. I know that from my history, but also another way of telling if you don't have that history built up yet, or if I do this anyway, just to make sure, as a sort of double confirmation, just do some quick math. I've done this before on videos, and just do some quick math and find out where you are at on the curve. So let's show that really quickly. If I pull up my LVX platform. Oh no, my deltas are not showing up. I don't know why, but for some reason, the last few days I've been having some trouble with these deltas showing up on my platform. Yeah, those deltas are not showing up. So I've done this before, but let me. Yeah, they're not showing up, but typically what you'd want to do is, and I'll just do it right here for a particular option, even though I don't know this exact delta. But you'd want to divide the IV here. So like if I would take the 1080, the IV, and I would divide it by the at the money IV, and then that would give us a specific number. And then once you get that number, then you can go ahead and find out where the curve is, if it's steep, if it's a flat curve. So SPX normally falls between 135 and 140%. So that number it's going to give you, you're going to multiply that by 100. So what does that mean? So so that means you're going to do the division, you're going to multiply by 100. So divide the 10 delta put option, divide it by the at the money IV put option. So divide those two implied volatilities, and you're going to get a number. You multiply that by 100, and then you'll find out where it is. If it's above 140, then that's going to be a good skew. If it's below like 135, then that's kind of flat. I'll write a blog post on this to make sure it's more clear. It's probably about as clear as mud after that example because I don't have, for some reason, the deltas. I don't know why they're not showing up on my platform right now. They've been intermittently showing up and not showing up lately. So I'll write a blog post about that to make that more clear. All right, next, so trade example. We have a broken wing condor trade. This is kind of an example trade of what I like to do. Typically, I do it on the put side, but like I said, actually lately, I've been thinking more about doing it on the call side. And this next expiration cycle, I think I might go in on the call side because I think the market's going to go down. But that's just me. So typically, I sell an 8 to 13 delta. I'm selling these puts at 60 to 70 days of expiration. Remember, I said that's kind of my sweet spot of where I like to sell options. I'm buying an at-the-money debit spread in a ratio of 1 debit spread for every 10 to 15 contracts sold. And I'm buying enough units that I'm net long puts. And that's because I'm typically trading numerous contracts on this, so several $1,000s, and I don't want to, I don't want to go broke. I make sure I'm selling a good skew. This is most likely going to happen by trading on a down day, on a day when the market kind of takes a little blip down. Like today would not be the kind of day you'd want to be doing this, most likely, because well, the market's up a few points and it's pretty flat. So odds are you're not going to get a good price. So you want to look at the RVX also when doing this. What is the RVX? The RVX is the volatility index for the Russell. So if you were trading the SPX, you'd want to look at the VIX. I don't know what the volatility index is on the OEX, but if you were trading, let's say the NDX, you'd want to look at the the volatility for that. So whatever you're trading, you want to know what the volatilities are. And so, for example, last year when I traded an RVX over 20, so we could see what's the RVX right now. The RVX is 1787. Not a good RVX to sell. Russell, flat. Not a good day to sell. So when I sold an RVX over 20, I was in the trade 17.5 days on average. That's awesome. That's 3 weeks in the trade, and boom, I get my money. I'm in, I'm out. And then I'm on the sidelines in cash waiting for the next opportunity. That's the best thing that can happen. But last year when I sold, that should be an X, sorry for the typo, last year when I sold an RVX under 20, so that means I was selling a little bit flatter curve, there wasn't as much juice, I just didn't get in on a good day, whatever the case, I was in the trade about 33 days. It's twice as long. That sucks. My risk in the market is so much greater. Think about how much more risk I have by being in the market for 33 days in an active position than I do have being in a trade 17.5 days. So much more can happen, so much more can go wrong. Being on the sidelines, it's the best place to be because you can't get hurt. But when you're in a trade for 33 days, now you increase the likelihood of having to make adjustments. It's on your mind, so there's a sort of a mental fatigue. You can't do anything else with that capital. That capital's locked up. So if you found another opportunity, you wouldn't be able to pursue it, possibly. And again, the likelihood of a crash or something else happening in that you're in the market increases drastically. So if you could only be in the market for half of the trading days for the year and make the same amount of money, I mean, wouldn't that be better than being in the market every day? Of course. Of course. You have far less risk, less mental anguish, and less worry. So as far as returns are concerned, if you have a portfolio margining account, and if you don't know what a portfolio margin account is, then that probably means that you don't have enough money for it. A portfolio margin account is typically anywhere between 125 and 150,000, and it requires a fairly extensive trading background in order to obtain one. All that means is that they set aside a certain amount of money for each trade based on their calculated risk for the position. So they use an algorithm to calculate how much risk you have, and then that changes on a day-to-day basis. For example, during times of higher volatility, when the perceived risk is higher, like 2008, for example, your margin would have been higher than during times of lower volatility. That's how portfolio margining works. You can make returns on this type of trade anywhere between 10 and 15% in a portfolio margin account, which is pretty damn good. In a Reg T account, you're looking at anywhere between 3 and 8%. That's because in Reg T, you have to put up more margin, and the capital stays there no matter what. No matter if the trade's going really well for you and it's going to be a winner, or if you're getting crushed in the trade, the margin stays the same. So that's why the returns are less. I have a Reg T account, by the way. So trade example, broken wing condor. This is what the trade is going to look like. So as you can see, we have what looks like a credit spread, and then we have that embedded debit spread at the money. And what that does is it flattens out this this T-0 curve. It flattens out the short-term, our short-term trading graph. So the red is the expiration site, is the expiration graph, and the white is the short-term graph. That's the current one. It flattens this out, which reduces our risk and just sort of hedges the position. But that debit spread also pops this graph up. As you can see, it adds more money into the trade right here when we get closer to risk. So what that means is, as the market starts to push against me and gets closer to my short strike here, so as I'm taking on more risk, I'm being compensated money in the trade. So that's kind of nice. If I'm going to take on more risk, I want to be able to have more profit potential. And then if you extended this out, you'd see this curve actually curves up towards the back end here, and that's because of the units that I purchased that make me long net puts on the position, and that's going to give me that insurance in case there's a crash or anything else. And remember, when there's a crash or something crazy, a crazy event like that happens, remember the volatility is going to spike drastically. It's going to go up huge. And what that's going to do is that's going to raise that entire short-term white graph. It's just going to raise that thing up. Because in these positions, as the volatility goes up, the money's going to go up as well. So as you move down in the graph, especially as the vol spikes, you're going to lose a lot less money than you would based on looking at this graph right now, if that makes sense. It's because of that skew shift that we talked about earlier. So how do I manage these positions when I put them on? When I get this on, this is the start. Then what happens? Because a trade is only as good as the plan and how you execute it. So the entry is great, and if you get in the trade, perfect. But then what happens when you're in the trade? Because if something goes wrong, you better know what you're going to do before it happens. So how I manage these trades is, if my short strike option gets to 4 delta or less, I sell the debit spread to increase theta and pop up the expiration graph. Puts more money in the trade. So what that means is, if it's going really well and the market starts to go up, let's say, there's a certain limit here on how much money I can make. So going when the trade's going really well and in your favor, you're kind of limited on how much you can make. So I'll sell off that debit spread, which of course flattens this out, and it pulls some of the profit out towards my short strike, but it adds money in out here where you know, closer to the money. So that's just sort of you know, you're removing your hedge. There's more money now in the trade as you get closer to the money, and you know, you'll be able to make a little bit more money than in the trade. So that might increase you from, like, let's say a 3.5% profit to like a 4% profit, or 4.5% profit. But that's if things are going great, and that's the kind of position you want to be in when things are happening and it's all good. But if the short option gets to 16 delta, then that means it's pushing against me. Then we're down here somewhere. I'm getting hurt in the trade. Then I start to think about rolling. I start to think about taking it off and repositioning. I might do it right away, but I might wait. It all depends on, are there any announcements coming out? What does the graph look like? What does the chart for the Russell look like? What is the RVX telling me? You know, are there just sort of what's going on holistically in the market? You know, is there a lot of fear? If so, why? You know, do I think it's going to be short term, or is this a longer term issue? All these things come into play and go into my decision of whether or not I want to roll at 16 or not. If I decide not to roll, I might hold off till about 18 delta, and then at 18 delta, usually it's like, okay, no brainer, no matter what I think, even if I think the market's going to come back, I'll roll down, because I don't want to get down too much money in this position. That's the worst thing that can happen, is you get down too much money, because then there's going to be this psychology element of trying to make that money back, and you don't want to be in a position where you're down at so much money that you have sunk costs, and then you sort of get married to the position because you want to try so hard to be right and to make that money back. That's just a bad spot to be in. So usually, no matter what, I'll roll down at 18, and I'll go down about 30 points is what it usually comes down to. So I'll take the position off, I'll roll down and sell twice as many contracts about 30 points down. Now, you might say, hey, if the position's going against you, why are you going to not only stay in the position but also add capital to the position? That sounds like a losing bet. It sounds like a bad play. You're adding capital to a bad position. Well, hold on for a second. I'm rolling down, but like I said, I'm holistically looking at the market. I'm looking at the charts. I'm taking all these factors into account. So it could have just been a short-term blip down where, you know, hey, we hit a little rough spot. We came down a little bit. Trade went against me. No big deal. Reposition. Yes, I'm doubling my size to try to earn back, you know, some of that money that I locked in some of the losses that I locked in when I rolled that position down. But if for everything in the market that I'm looking at tells me that we're either going to go sideways from here or we're going to go up, then it's not a bad bet. It's a fine bet, you know. And I'll only roll once. I won't roll a second time. If I'm wrong again and it comes at me again, and I get down to 16 delta, I take the thing off and I wait until next cycle. I say, hey, you know what? It wasn't my time. It was a bad spot. It was a bad trade. Either my entry was off or there's something crazy happening, and I won't roll down again. So I'm not doing a strategy in which I just consistently roll down and double up and double up and double up. No, I only do it once. And honestly, I can't recall a time when I actually even thought about doing it a second time. And not only that, but usually if I end up taking it off and I roll down, it's either worked out or I just have never repositioned it. So, you know, keep that in mind. But as I mentioned before, these are just sort of guidelines. This is just how I manage the trade, how I enter the trade. Everything is a guideline. This is a framework for success. But you are. So again, if you get down to 18 and your rules say, hey, roll down and double up your position, but the market says that the war just started and we might get bombed and all these other factors are happening, and there was a terrorist attack, well, maybe you shouldn't roll down then. Be a little smarter than that. So always remember, this is just a framework. These are just guidelines. You want to follow them when it makes sense, and you want to use them in order to not make drastic snap decisions. You want to use them as your trading plan. You want to use them so when you get in a spot when the market's moving against you, you don't have to think. You can just react to how the market is moving. But again, they're just a framework, and you want to use them when it makes sense to use them. So how do I exit the trade? I typically exit when I capture 80% of the profit in the short options. If I roll down, or if I'm fighting the trade, I might hold to expiration, but this is rare. So I did have a case though with the May expiration cycle where I rolled down. It just so happened I got into the trade, went against me, boom, I rolled down. I actually doubled the capital, and I was fighting the trade for quite a while. I made my money back, and I started to make a profit, and by that time, we were already down to about 2 weeks to expiration. So at 2 weeks to expiration, I decided that it just wasn't worth it for me to take it off. So what I did was I sold out the hedge, and I let the shorts expire. I wouldn't recommend that on a regular basis, but again, if you have to fight the trade and you're in the trade a really long time to get your money, at that point, if there's not much time left to expiration, maybe leave it on. It might make sense in terms of commissions and other factors to leave it on. But typically, you want to take those short options off when they decay down to 20 cents or less. So if you have a short spread and it's trading at 15 cents, just take it off usually. Unless there's only maybe a week to expiration, usually I would just take it off. It's just usually not worth the risk. All right, that's it. Obviously, since there's nobody on board, I can't really ask questions, but remember, these are just sort of guidelines. This is just how I kind of trade this thing. Also want to say, I didn't come up with these. Much smarter people than I, did a lot of back trading, a lot of back testing, and a lot of real-time trading to come up with these guidelines. I'm just been fortunate enough to find those people, and then also fortunate enough to be able to implement them with a little bit of smarts, a little bit of wisdom and luck, and have things work out well for me. So take these guidelines and use them as a framework for success. Don't follow them blindly, and always keep a good frame of mind when doing these trades, even if you're having success. So that's it for today. Thanks everybody for watching, and I will see you again next time.